Welcome back. Let's dive into a new topic. This new module will focus on the key metrics used to assess operational performance in income producing real estate. Understanding these is vital for both property management companies and individual real estate investors who want to optimize how their properties are managed and ensure they're getting the best possible returns. These operational metrics will help any investor better understand their property's performance, identify areas for improvement, maximize return on investment, and make informed decisions based on measurable and objective data. In this series, we'll review a comprehensive set of key metrics used for evaluating the day to day financial health and efficiency of income generating real estate. We'll be covering potential gross income, effective gross income, net operating income, operating expense ratio, the break even ratio, gross rent multiplier, appreciation, depreciation, days inventory, outstanding, asset turnover, and the occupancy rate. Let's get started with the basics of income generating real estate. Understanding income generating real estate. Before we jump into the specific metrics, what exactly do we mean by income generating real estate? Income generating real estate is a type of real estate investment where the main goal is to produce an ongoing stream of income, typically from rental fees paid by tenants. What are the key characteristics? Ongoing rental income. This is the primary financial benefit. Returns measured as a percentage of the investment. Investors look at yields and returns on their capital. Long term investment horizon. Often these aren't quick flips. The focus is on creating a steady cash flow over time. What types of assets are we talking about? This can include a wide range of residential properties like apartment buildings or single family rental homes, offices and commercial centers like shopping malls, warehouses and industrial properties and hotels. What are the advantages? Consistent passive income. This means regular cash flow without daily active work like a typical job. Stable investment. Real estate can often be less volatile than other investment types. Hedge against inflation, rental income, and property values often rise with inflation, protecting your purchasing power. Regarding disadvantages, high initial investment. Buying property usually requires significant capital upfront. Ongoing operating expenses. Properties need continuous management, maintenance, and have costs like taxes and insurance. Risk of occupancy rates. There's always a chance units might be vacant, leading to lost income. Complexity in management. Dealing with tenants, repairs, and legalities can be challenging. Now that we have a basic understanding, let's begin with our first operational metric potential gross income. Potential gross income, PGI. When you look at an investment property like an apartment building, what's the absolute maximum income it could generate if everything was perfect? That's what potential gross income, or PGI, tells us. PGI is the total amount of money that an income generating real estate asset could theoretically produce from all sources like rent and parking fees before any expenses are taken out. This calculation assumes two ideal conditions. The property is 100% fully occupied, every single unit is rented out. All tenants pay their full rental rates on time. Because these are ideal conditions, PGI is a theoretical measure. It doesn't reflect the actual income you'll likely collect. However, PGI provides a picture of the maximum possible income the asset could generate under perfect circumstances. In other words, it's a calculation of what could be earned if everything goes perfectly right. Full occupancy, all rents paid promptly, etc. Why is PGI important? PGI serves as a fundamental starting point for evaluating the income potential and eventually the value of an income generating property. It allows investors to see the gross theoretical earning power of the asset. However, it's really important to use PGI with caution. It should always be considered alongside other more realistic metrics to get an accurate picture of actual profitability. Think of it as the ceiling, the highest possible income. How do we calculate PGI? For a simple property like an apartment building, the calculation is straightforward. PGI equals the number of units multiplied by the average rent per unit. This would typically be calculated on an annual basis. Let's make this concrete. Assume we have a residential building with 10 apartments. Each apartment is rented for $5,000 per month. Let's calculate the monthly and annual PGI. Monthly PGI equals 10 apartments multiplied by $5,000 per apartment equals $50,000. Annual PGI. Annual PGI equals $50,000 multiplied by 12 equals $600,000. So in this case, the annual PGI of the building is $600,000. This figure represents the total potential income the building could generate in a year, assuming all 10 apartments are occupied for the entire year and all tenants pay their $5,000 monthly rent in full and on time. Of course, the real world is rarely perfect. What happens when we account for vacancies and non payments? That brings us to our next metric: effective gross income, EGI. We've just discussed potential gross income, which is the perfect world income. But what about the income a property actually collects? This is where effective gross income, or EGI, comes in. It gives us a much more realistic picture. EGI is a financial metric that represents the total actual income received from a property after you account for potential losses. Specifically, it's the PGI minus potential rental loss due to vacant units. This is the income loss because some units were not rented out. Non-collection of debts. This is the income loss because some tenants didn't pay their rent even if their unit was occupied. So, EGI is a real measure. It reflects the income that was actually collected or is realistically expected to be collected. You might also hear EGI referred to as gross operating income. If the property has other income sources besides rent, like laundry machines, vending, or certain fees, those would typically be added in as well to get to EGI. Why is EGI important? Profitability assessment. EGI provides a clear picture of the actual income a property is generating. It's a crucial number because it serves as the basis for calculating other important financial metrics, most notably net operating income, NOI, which we'll cover next. Property comparison, EGI can be used to compare the income performance of similar properties more accurately than PGI because it accounts for real-world occupancy and collection issues. How do we calculate EGI? The basic formula is EGI equals PGI minus potential rental loss due to vacancy and credit loss. Let's see an example. First, the data for our asset. An asset has 10 housing units. The monthly rent per unit is $5,000. The average occupancy rate is 90%. The loss of income due to non-collection of debts, credit loss, is 2% of PGI. Now let's look at the calculation process step by step based on the provided information. Calculation of potential gross income, PGI, equals number of housing units multiplied by monthly rent per unit multiplied by 12 months. PGI equals 10 units multiplied by $5,000 per unit per month multiplied by 12 months equals $600,000. So our PGI is $600,000. Calculation of loss of income due to vacant units, vacancy loss. Vacancy loss equals PGI multiplied by 1 minus occupancy rate. The occupancy rate is 90%, so the vacancy rate is 10%. Vacancy loss equals $600,000 multiplied by 0.10 equals $60,000. Calculation of loss of income due to non-collection of debts, credit loss. Credit loss equals PGI multiplied by debt loss percentage. The debt loss percentage is given as 2%. Credit loss equals $600,000 multiplied by 0.02 equals $12,000. Calculation of effective gross income, EGI. EGI equals PGI minus vacancy loss minus credit loss. $600,000 minus $60,000 minus $12,000 equals $528,000. So while the PGI was $600,000, the more realistic EGI for this property is $528,000 after accounting for the expected vacancies and credit losses. This EGI figure is what we then use to figure out the property's income after its day-to-day running costs. This brings us to net operating income. Net operating income, NOI. We figured out the realistic income a property collects, EGI, but owning and running a property costs money, things like maintenance, property taxes, insurance, and management fees. What's the profit from the property after these day-to-day operating expenses are paid, but before we consider any mortgage payments or income taxes? That's net operating income. NOI is a key financial metric that represents the profit of an income-generating asset after you deduct all operating expenses from the EGI. It's very important to note that NOI is calculated before deducting financing expenses like mortgage principal and interest and income taxes. What are some typical operating expenses? These include property management fees, insurance, property taxes, repairs and maintenance, routine upkeep, fixing things, utilities and advertising and marketing expenses to attract tenants. Sometimes a reserve for replacement, money set aside for future major repairs like a new roof, is also factored in or considered near operating expenses. Why is NOI significant? NOI is incredibly important because it shows how much money the asset itself actually generates from its ongoing operations, regardless of how the owner financed the property, whether they used a loan or paid all cash, or their personal income tax situation. It isolates the property's operational profitability. How do we calculate NOI? The formula is NOI equals EGI minus operating expenses. Key uses of NOI. NOI isn't just a number, it's used in many critical ways. Asset valuation. NOI is one of the most important components in calculating the value of an income-generating property. Investors use NOI to calculate the capitalization rate, cap rate, which we'll discuss later in our next course. Profitability analysis. NOI provides a clear picture of the net income the property generates purely from its operations, before considering debt service and income taxes. This helps investors and property owners understand the true operational profitability of the asset. It also helps in assessing the level of risk involved by examining the stability and consistency of these earnings over time. Investment decision-making. NOI allows investors to compare different properties on an apples-to-apples basis regarding their operational performance, even if each property has a different financing structure, one bought with cash, another with a large mortgage. This helps them choose the best investment by focusing on the property's intrinsic ability to generate income. It's also the income stream that needs to be sufficient to cover any mortgage payments and still leave a profit for the equity investor. Let's look at a simple example. EGI, $500,000. This is the total actual income collected. Annual operating expenses, $200,000. Now, let's calculate the annual NOI. NOI equals $500,000 minus $200,000 equals $300,000. This $300,000 NOI is the net income produced by the property's operations before any debt payments or income taxes are considered. It's a critical figure for valuation and for determining if the property can service debt and provide a return to the owner. We're looking at a comparison of EBIT and NOI. First, regarding their general use, EBIT is a broad profitability metric used across all industries for company-wide analysis. NOI is specific to real estate investments, focusing on the operational performance of a single property. Next, concerning financing expenses or taxes, both EBIT and NOI exclude these items. They measure earnings before interest and taxes. Now, for the basic calculation, revenue minus expenses. EBIT is company revenues minus total company operating expenses. NOI is property revenues minus direct property operating expenses. Finally, typical included expenses. EBIT includes cost of goods sold, company-wide marketing, and general and administrative expenses. NOI includes property-specific expenses like management, maintenance, insurance, property taxes, and an allowance for vacancy. In short, while both give a pre-debt, pre-tax profit view, EBIT is for overall company performance, and NOI focusing on the operational results of an individual real estate asset. Operating expense ratio, OER. We know that NOI is what's left after paying operating expenses, but how can we judge if those operating expenses are too high, too low, or just right for the amount of income the property is bringing in? This is where the operating expense ratio, or OER, comes in handy. The OER is a financial metric that measures a property's operating expenses as a percentage of its EGI. Essentially, this metric tells you how much of every dollar of actual gross revenue collected is used up to cover the day-to-day operating expenses of the property. It's a key indicator of the operational efficiency of an income-generating real estate asset. It shows the cost of running the property compared to the income it actually generates. Why is OER important? It's a metric used for analyzing how efficiently the operating expenses of an income-generating asset are being managed. The OER allows investors and managers to compare the operational efficiency between similar assets in the same area or market segment. For instance, if you own several apartment buildings, you could compare their OERs to see which ones are being run more cost effectively. What does the OER mean? A low operating expense ratio generally indicates better operational efficiency. This means the company or property owner is spending less to generate its revenue. A high operating expense ratio indicates that a larger portion of the revenue is being used to cover operating costs. This might suggest inefficiencies, that expenses are too high, or perhaps that the property requires significant maintenance. How do we calculate OER? The formula for the operating expense ratio is OER equals total operating expenses divided by effective gross income multiplied by 100. Let's consider an office building with the following annual data. Annual operating expenses $200,000, annual EGI $500,000. Now, let's calculate the OER. OER equals $200,000 operating expenses divided by $500,000 EGI multiplied by 100 equals 40%. An OER of 40% means that 40 cents of every dollar of EGI generated by the building goes towards covering its operating expenses. The remaining 60 cents contributes to the NOI. It's useful to see how NOI and OER relate, as they both use the same core data, EGI and operating expenses, but tell us different things. Regarding NOI, it calculates the difference between EGI and operating expenses. It presents the property's operating profit in monetary terms, dollars. Regarding OER, it calculates the ratio between operating expenses and EGI. It presents the operational efficiency as a percentage. So while both metrics utilize the EGI and operating expenses, NOI gives you a picture of the absolute financial profit from operations, whereas OER allows you to evaluate the efficiency of those operations in percentage terms, making it very useful for comparisons. Now let's think about the point at which a property's income just covers its costs. This is known as the break-even point. For any business or income-producing property, There's a crucial level of operation where you're not making a profit, but you're not losing money either. This is the break even point. The break even point is the point, whether in financial terms, like total revenue, or quantitative terms, like number of units rented, where the total operating revenue is exactly equal to the total operating expenses. This point indicates the minimum level of business activity, minimum occupancy or sales required to cover all your costs, resulting in zero profit and zero loss from operations. The break even point can be expressed in different ways as a monetary amount, e.g., the break even point for this property is $100,000 in rental income per year, or as a quantity of units, e.g., we need to rent 15 out of 20 apartments to break even. Often, the break even point is shown on a graph where it's the intersection point between the total revenue line and the total expenses line. Any sales or rental income generated beyond this break even point contributes to the operating profit of the company or property. Why is the break even point important? Understanding the break even point is vital for several reasons. Informed decision making. Knowing your break even point allows businesses and property owners to make much more informed decisions about things like pricing strategies, e.g., what rent to charge, sales volume targets, e.g., how many units need to be occupied, evaluating new investments or projects. It provides critical insights into the relationship between costs, volume, and profit. It's a crucial tool for strategic business planning, cash flow forecasting, setting sales targets, analyzing the profitability of different products or areas of operation, and assessing the overall viability of a project. Risk management. The break even point helps identify the minimum sales or occupancy level required to cover all expenses, which in turn helps in reducing the risk of incurring losses. When a business or property manager knows its break even point, they can set a minimum revenue target for their operations. This reduces financial risks and increases the certainty in financial management. For example, if you know you need 70% occupancy to break even, you can focus marketing efforts to ensure you reach that level. How do we calculate the break even point? There are formulas to calculate the break even point, depending on whether you want to find it in terms of units or in terms of total revenue, dollars. The formula for a break-even point in units is break-even point units equals total fixed expenses divided by selling price per unit minus variable cost per unit. The selling price per unit minus variable cost per unit part is often called the contribution margin per unit. The formula for break-even point in dollars is break-even point dollars equals total fixed expenses divided by 1 minus variable cost per unit divided by selling price per unit. Let's define those terms in a real estate context. Fixed expenses. These are costs that do not change with the level of activity, like the number of units rented or sold. Examples in real estate: property taxes, building insurance, fixed property management fees, salaries for permanent administrative staff, fixed maintenance costs like landscaping for the entire complex or cleaning of common public areas, and fixed financing expenses such as mortgage interest payments. Variable cost per unit. These are expenses that do vary directly with the level of activity per unit rented or sold. Examples: maintenance costs specific to individual rented units, like repairs within an apartment, utilities consumed within rented apartments if paid by the owner, brokerage fees or commissions paid for renting each unit, selling price per unit. This is the price at which a single unit is rented or sold. Examples: the monthly or annual rent for an apartment, or the selling price of a condominium unit or property. Let's look at a rental project. Number of rental units in the project, 20. Total annual fixed expenses, $600,000. Variable expenses per unit per year, $12,000. Annual rental income per unit, selling price per unit, $48,000. Calculating the break even point in quantity units. $600,000 divided by $48,000 minus $12,000 equals $600,000 divided by $36,000 equals 16.67 units. Since you can't rent 0.67 of a unit, the developer needs to rent at least 17 units to reach the break-even point. Break-even point in revenue, dollars, $600,000 divided by 1 minus $12,000 divided by $48,000 equals $600,000 divided by 0.75 equals $800,000. So the project needs to achieve an annual rental income of $800,000 to break even. This means the developer needs to rent at least 17 of the 20 units or achieve an annual total rental income of $800,000 just to cover all fixed and variable costs. Renting the 18th, 19th, and 20th units will generate profit. This break-even point can be shown visually on a graph. The graph typically plots the number of units rented or sales volume on the horizontal axis, x-axis. The total dollar amount for revenues and expenses on the vertical axis, y-axis. You'll see a total expenses line in red, which starts at the fixed expense level and slopes upward because total expenses increase with each unit rented due to variable costs. A total revenues line in green, which typically starts at zero and slopes upward as each unit rented brings in revenue. The break-even point is where the total revenues line intersects the total expenses line. To the left of this point, fewer units rented, expenses are higher than revenues, so there's a loss zone. To the right of this point, more units rented, revenues are higher than expenses, so there's a profit zone. The graph from the example shows the break-even point at 16.67 units and $800,000 in revenue, clearly marking these zones. Now, related to the break-even point, there's also a break-even ratio. Break-even ratio, BER. We've seen that the break-even point tells us the exact dollar amount or number of units needed to cover costs. The break-even ratio, BER, takes this a step further by expressing this point as a percentage relative to the property's actual income. What is the break-even ratio, BER? The break-even ratio is the ratio between the break-even point in monetary value, the dollar amount of revenue needed to break even, and the property's actual total income received, which is the EGI. This ratio is expressed as a percentage. How does the break-even point compare to the break-even ratio? The break-even point indicates the exact value in quantitative terms, dollars or units, where the business is in balance, no profit, no loss. The break-even ratio indicates that same threshold, but expresses it as a percentage of the actual income. This percentage format often makes it easier to compare the risk or efficiency between different businesses, properties, or time periods. For example, saying a property has an 80% break-even ratio is often more immediately comparable than just stating its break-even revenue in dollars, especially if you're comparing it to another property with a different income level. How do we calculate the break-even ratio? BER equals break-even point in monetary value divided by EGI multiplied by 100. The BER is important for several financial management aspects. Risk assessment. The break-even ratio helps investors and lenders assess the level of financial risk in an investment or a property. A higher ratio indicates a higher level of risk. Why? Because it means the business or property needs to use a higher percentage of its actual current revenue just to cover its expenses. For example, a BER of 70% indicates that the business needs to use 70% of its total EGI just to break even. Conversely, the lower the ratio, the lower the risk because a smaller portion of the income is needed to cover costs, meaning there's a larger buffer or margin of safety before the property starts losing money. Financial planning. The break even ratio helps in planning the budget and forecasting the cash flow of the asset over time. Knowing what percentage of your EGI is your break even point helps in setting targets and managing expectations. Determining loan terms. Lenders like banks often use the break even ratio, among other metrics, when they are deciding on loan terms for a property, such as the interest rate they'll offer and the maximum loan amount they're willing to provide. A property with a lower, better BER is less risky from a lender's perspective. Let's continue with the data from our previous break-even point example. 20 rental units. Annual fixed expenses equals $600,000. Variable expenses per unit per year equals $12,000. Annual rental income per unit equals $48,000. From this, we calculated the break-even point in monetary value to be $800,000. Now we need the EGI to calculate the BER. Let's add new data. For simplicity, assume 100% occupancy and 100% rent collection. In this case, EGI will be equal to the potential gross income, PGI. PGI equals 20 units multiplied by $48,000 per unit equals $960,000. So our EGI is $960,000. Now calculate the break-even point ratio. BER equals $800,000 divided by $960,000 multiplied by 100. BER equals 83.33%. A break-even point ratio of 83.33% means that 83.33% of the property's EGI will go towards covering all the expenses fixed and variable. The remaining portion, 100% minus 83.33% equals 16.67% of EGI, will be the NOI. This also means that if the EGI drops by more than 16.67%, the property will not break even. There is another method to calculate the break-even point ratio based on potential gross income, PGI. PGI-based break-even ratio measures the ratio between total expenses and total potential gross income. It's often used to estimate the occupancy rate required to break even under optimal conditions, to achieve full PGI for every occupied unit. As with the EGI-based BER, a lower ratio here generally indicates lower risk. Calculation formula for PGI-based BER. PGI-based break-even point ratio equals total expenses divided by total potential income, PGI, multiplied by 100. Total expenses here would likely include fixed expenses plus variable expenses at the break-even number of units or just total operating expenses if that's the focus. Comparison of calculation methods. EGI-based versus PGI-based BER. PGI-based BER uses potential income, assumes full occupancy and collection for calculated PGI. Provides a more optimistic estimate of the break-even occupancy threshold. Might be suitable for initial planning or understanding the best-case scenario target. EGI-based BER uses actual or realistically expected income. EGI accounts for vacancy and credit loss. Provides a more realistic picture of the break-even situation, more suitable for accurate risk assessment and ongoing operational management. Example of PGI-based break-even point ratio. Scenario: a real estate developer is evaluating the feasibility of investing in a building with 20 units. Data: total annual expenses, fixed plus variable, $900,000. Total potential income, PGI, $1,200,000. Calculation: PGI-based break-even point ratio equals $900,000 total expenses divided by $1,200,000 PGI multiplied by 100 equals 75%. Interpretation: the developer needs to achieve an occupancy level that generates income equivalent to 75% of the total potential income just to cover all expenses and reach the break-even point. If PGI is based on renting all 20 units, this implies they need to rent out 75% of the units, which is 15 units, to break even. If occupancy in terms of collected PGI level rent is above 75%, the project makes a profit. If occupancy is below 75%, it incurs a loss. Next, we'll look at a quick valuation tool often used for comparing rental properties, the gross rent multiplier. When you're looking at rental properties, especially residential ones, you might wonder if there's a quick rule of thumb to see if a property's price is reasonable compared to the rent it brings in. The gross rent multiplier, or GRM, is often used for this kind of initial assessment. What is the GRM? The GRM is a financial tool used to get a rough evaluation of the value of an income generating real estate property. It's calculated as the ratio of the property's price or current market value to its annual potential gross rental income. Remember, potential gross rental income is the total rent you'd collect if the property were 100% occupied and all tenants paid market rent before any expenses. This multiplier basically tells you how many years it would take for the property's gross rental income to pay back the purchase price if you completely ignored all operating expenses. What does the GRM indicate? A lower GRM generally suggests a more attractive property from a price to rent perspective, as it implies a shorter time to recover the investment through gross rents. A higher GRM might indicate a less attractive property on this simple measure, signifying a longer time to recoup the investment through gross rents alone. Usage and limitations of GRM. Usage. Investors often use the GRM to quickly and easily compare similar properties in the same area. It can help in spotting potential investment opportunities that might warrant a closer look. For example, if most houses in a neighborhood have a GRM of 10 and you find one with a GRM of 7, it might be relatively underpriced for its rental income. Limitations. This is where you need to be very careful with GRM. It does not take into account any operating expenses, like property taxes, insurance, maintenance, management fees, utilities, etc. Two properties might have the same GRM, but if one has much higher operating expenses, it will be far less profitable. Because it ignores expenses, the GRM should always be used in combination with more comprehensive financial metrics, especially NOI and cap rate, to get an accurate picture of a property's actual profitability. The GRM is generally not suitable for in-depth analysis of complex properties or properties that have significantly varying occupancy rates or rent levels. It's a rough starting point, not a final decision tool. The formula is GRM equals property price divided by gross annual rental income. What can cause the GRM to be higher or lower in a market or for a specific property? Location. In high demand locations, like popular city centers, property prices often rise much more significantly than rental rates. This typically results in a higher GRM in those areas. This higher GRM reflects the strong potential for future value appreciation and the high demand in that prime area. Property condition. Properties that are in better condition, well maintained, or recently renovated usually command higher prices, and this can lead to a higher GRM. While rental rates might increase somewhat with better condition, the property price often increases at a significantly higher rate due to expectations of lower future maintenance and stronger value appreciation. Supply and demand. In a market where demand for properties is high and supply is low, both property prices and rental rates tend to increase. Often, property prices rise at a faster rate than rents in such scenarios, leading to a higher GRM. Interest rates. A decrease in interest rates can lead to a higher GRM. Why? Increased purchasing power. Lower financing costs, cheaper mortgages, can increase demand for property purchases, driving up prices. Impact on rents. Paradoxically, when interest rates drop significantly, making buying more accessible, rental rates might not keep pace or could even slow down their climb. The overall outcome tends to be property prices increasing at a faster rate than rents. Economic growth or recession. Economic growth often leads to a higher GRM. When the economy is doing well, people have more disposable income, which boosts demand for property purchases. Investor optimism during these times also fuels expectations of significant property value appreciation, driving prices up, sometimes faster than rents can follow. Inflation. Inflation usually causes property values to increase, often faster than rents in the short term, resulting in a higher GRM. This happens because property is often seen as a good hedge against the decreasing value of money during inflationary periods. People want to own hard assets. Although rents might also increase with inflation, the relative rise in property values typically leads to an increased GRM. Let's say you're looking at an apartment building, property price $1 million. Dollars. This is the purchase price of the building. Gross annual potential rental income $100,000. This is the total rent if all units were rented at market rates for the full year. Now let's calculate the GRM. GRM equals $1 million divided by $100,000 equals 10. What does this GRM of 10 mean? It means the property's price is 10 times its gross annual potential income. In very simplistic terms, and ignoring all expenses, it would take 10 years to recoup the investment in the building just from the gross rental income. Now, if you find out that the typical GRM for similar properties in that specific area is, say, 8, while the GRM of the building in your example is 10, this might suggest that the building in your example is relatively more expensive compared to the gross income it generates, or conversely, the ones with GRM 8 are cheaper for their income level. This would prompt you to investigate why. Is it in better condition? Is there a reason for the premium, or is it simply overpriced? Remember, GRM is a starting point. You'd always dig deeper with NOI, cap rate, and other metrics. Next, let's talk about how property values themselves can change over time. Appreciation. One of the exciting aspects of real estate investment for many people is the potential for the property's value to go up over time. This increase in value is known as appreciation. What is appreciation? Appreciation is simply an increase in the value of an asset over a period of time. When we talk about real estate, it means your property is worth more today than when you bought it. Why is appreciation important for investors? It's a potential source of capital gains. If your property appreciates, you can sell it for more than you paid, resulting in a profit, capital gain, on top of any rental income you might have earned while you owned it. What are the risks? It's crucial to remember that appreciation is not guaranteed. Asset values can also decrease, which is depreciation of market value or a market downturn, or they can stagnate. Market conditions, economic factors, and property specific issues can all influence this. How do we calculate appreciation? There are two simple calculations. Absolute appreciation in dollar terms. Appreciation dollars equals current value minus previous value or purchase price. Appreciation rate as a percentage. Appreciation rate equals current value minus previous value divided by previous value multiplied by 100. What makes a property go up in value? Many factors play a role. Location, this is often the biggest driver. Assets located in central high demand areas, e.g., vibrant city centers, desirable neighborhoods with good schools, tend to appreciate more in value than assets in more remote or less sought after areas. Proximity to employment centers, good educational institutions, public transportation, and entertainment hubs almost always positively impacts an asset's value and its potential for appreciation. Regional development. What's happening around the property matters a lot. Infrastructure development projects such as the building of new roads, railways, airports, or large commercial centers can significantly increase the value of surrounding assets. Similarly, urban renewal plans or significant public investments in an area can drive up property values. Supply and demand. This is a fundamental economic principle. When demand for properties in an area exceeds the available supply, prices naturally rise, appreciate. Factors that can increase demand include population growth in the area, improved economic conditions, more jobs, higher wages, and low interest rates, making borrowing cheaper. Asset condition. The physical state of the property itself is important. Assets that are in good condition have been recently renovated or have desirable quality additions, like a new kitchen, updated bathrooms, or energy efficient features, tend to command higher values and appreciate more. Significant, well done renovations and improvements can substantially increase an asset's market value. Market conditions, macro level. The overall economic climate, prevailing interest rates, and changes in government policy, like tax incentives for homeowners or investors, significantly affect the real estate market as a whole. During periods of strong economic growth and low interest rates, asset prices generally tend to rise. Let's walk through an example. An apartment was purchased in 2018. The purchase price was $1,500,000. The current value in 2025 is $2 million. Let's calculate the appreciation. Absolute value appreciation in dollars. Value appreciation equals $2 million. Current value minus $1.5 million. Purchase price equals $500,000. The apartment's value increased by $500,000. Appreciation rate as a percentage. Appreciation rate equals 2 million minus 1.5 million divided by 1.5 million multiplied by 100 equals 33.33%. So the apartment's value increased by 33.33% from its purchase price over this 7-year period, 2018 to 2025. This means that for every dollar originally invested in the apartment at purchase, there was an additional 33.33 cents in asset value gained by 2025. This is an example of significant long-term real estate value appreciation. Now, while market value can appreciate, there's another kind of value change that's important for accounting and tax purposes: depreciation. Depreciation. While we hope our property's market value goes up, appreciates, the physical building itself experiences wear and tear over time. For accounting and tax purposes, this decline in the value of the physical structure is called depreciation. Depreciation is the decrease in the value of an asset over time due to factors like use and physical wear and tear. Obsolescence, other factors that reduce its usefulness or value. In real estate, depreciation primarily refers to the decline in the value of the buildings and improvements on a property. It's important to note that the land itself is typically not depreciated for accounting purposes, as land is generally considered to have an indefinite useful life and often appreciates in market value. Why is depreciation important, especially for accounting and taxes? Depreciation is recognized as a non-cash operating expense for tax purposes. This means that even though you're not actually spending cash on depreciation each year, you can deduct this expense from your taxable income from the property. This can reduce your overall tax liability, the amount of income tax you have to pay. The depreciation rates and methods allowed for tax purposes can vary significantly depending on the type of asset, e.g., residential rental versus commercial building, and the specific tax laws in your area. There are a few conceptual types of depreciation. Physical depreciation. This is the actual wear and tear from use, age, and exposure to the elements, e.g., roof wearing out, paint fading. Functional depreciation or obsolescence. This occurs when the asset loses value because its design, features, or technology are outdated compared to newer alternatives, even if it's still physically sound. E.g., an office building with an old layout that's inefficient for modern businesses. Economic depreciation or external obsolescence. This is a loss in value due to factors outside the property itself, such as negative changes in the neighborhood, e.g., a major employer leaves the area, adverse zoning changes, or general market downturns. How is this annual depreciation expense actually calculated? There are several methods. Straight line depreciation. This is the simplest and most common method. It allocates an equal amount of depreciation expense over each year of the asset's useful life. We'll look at this with and without a salvage value. Accelerated depreciation methods. These methods allow for faster, larger depreciation deductions in the early years of an asset's life and smaller deductions in later years. Let's explore these calculation methods. Straight line depreciation, no residual value. This is the most basic way to calculate depreciation. In the straight line depreciation method with no residual value, also called salvage value, it's assumed that the asset will be worth nothing at the end of its useful life and its value decreases at a constant even rate over that time. How is annual depreciation calculated? The formula is annual depreciation equals asset cost divided by useful life in years. Impact on financial statements. The calculated annual depreciation amount will be recorded as an expense in the property's income statement. This reduces your taxable income. The accumulated depreciation, the sum of all depreciation taken to date, will be recorded as a reduction in the asset's value on the balance sheet. The book value of the asset becomes its original cost minus accumulated depreciation. Straight line depreciation. Example. Let's say a building is purchased for $1 million. Its estimated useful life for depreciation purposes is 50 years. Assume no salvage value. Annual depreciation equals $1 million asset cost divided by 50 years useful life equals $20,000 per year. So each year for 50 years, a depreciation expense of $20,000 will be recorded. At the end of these 50 years, the total accumulated depreciation will be $1 million and the book value of the building will be zero. The graph clearly demonstrates this uniform decrease in the building's book value over its useful life. Straight line depreciation with salvage value. Now, what if we expect the asset to still have some value at the end of its useful life? This is called salvage value or residual value. Straight line depreciation with salvage value is a method that takes into account this expected value of the asset at the end of its useful life. Salvage value is the estimated value of the asset at the end of its useful life. For a building, it's an estimate of how much an asset will be worth when it's no longer useful for its primary purpose, whether that means it's scrapped or sold off. This is also sometimes called scrap value. Salvage value affects how the depreciation base is calculated, and therefore it can influence investment decisions and overall property valuation from an accounting perspective. In this method, the asset's book value does not decrease to zero at the end of its useful life. Instead, it decreases to the predetermined salvage value. A higher estimated salvage value might make an asset appear more attractive from a depreciation accounting standpoint, as the total amount depreciated over its life will be less. How is depreciation calculated with salvage value? In the depreciation calculation, the salvage value is first deducted from the asset's acquisition cost. This new amount, cost minus salvage value, is called the depreciable base. Then, this depreciable base is divided by the number of years of useful life. This way, the depreciation expense only relates to the portion of the asset's value that is expected to be used up or consumed over time. The formula for annual depreciation is annual depreciation equals asset cost minus salvage value divided by useful life. Example of straight line depreciation with salvage value. Data: an industrial machine is purchased for $170,000. It has a useful life of 5 years and an estimated salvage value of $20,000 at the end of those 5 years. Calculate the depreciable base. Depreciable base equals asset cost minus salvage value equals $170,000 minus $20,000 equals $150,000. Calculate annual depreciation. Annual depreciation equals depreciable base divided by useful life equals $150,000 divided by 5 years equals $30,000 per year. Here's how the values would look year by year. Year 1, annual depreciation, $30,000. Accumulated depreciation, $30,000. Book value at end of year, $170,000 minus $30,000 equals $140,000. Year 2, annual depreciation, $30,000. Accumulated depreciation, $30,000 plus $30,000 equals $60,000. Book value, $170,000 minus $60,000 equals $110,000. Year 3, annual depreciation, $30,000. Accumulated depreciation, $90,000. Book value, $80,000. Year 4, annual depreciation, $30,000. Accumulated depreciation, $120,000. Book value, $50,000. Year 5, annual depreciation, $30,000. Accumulated depreciation, $150,000. Book value, $170,000 minus $150,000 equals $20,000. Result: at the end of 5 years, the asset's book value has decreased to $20,000, which is exactly its estimated salvage value. The value does not reach $0 but stops at the salvage value. The graphical presentation for this example shows a linear decrease in the asset's book value from $140,000 after year 1 depreciation down to $20,000 by the end of year 5. The graph then shows the book value remaining constant at the $20,000 residual value for any year subsequent, illustrating that depreciation stops once the salvage value is reached. Accelerated depreciation. Straight line depreciation is simple, but sometimes assets lose more of their value or provide more of their benefit in their early years. Accelerated depreciation methods recognize this by allowing companies to deduct higher amounts of depreciation expense in the early years of an asset's use and lower amounts in the later years. This is in contrast to the straight line method, where the depreciation expense is spread evenly. Relevance in real estate. In the real estate world, accelerated depreciation is sometimes more relevant for commercial buildings than residential properties, as commercial structures or their components might be considered to lose value or become obsolete more quickly due to changing business needs or technology. It's important to understand that accelerated depreciation typically only defers tax payments to later years. The total amount of depreciation allowable for tax purposes over the asset's entire life usually does not change between different depreciation methods. You just get to take more of it sooner. Common methods for calculating accelerated depreciation. Sum of the year's digits, SYD. The depreciation amount each year is calculated based on a fraction derived from the sum of the digits of the asset's useful life. Double declining balance, DDB. The depreciation rate is typically calculated as double the straight line depreciation rate, and this rate is then applied to the asset's declining book value each year, not the original cost. These methods can be more complex to calculate than the straight line method, and it's always important to consult with accounting and tax professionals, as their use and specifics vary according to tax laws and accounting regulations in different jurisdictions. Why would a company choose to use accelerated depreciation? Tax benefits, tax deferral. Accelerated depreciation allows companies to deduct higher depreciation amounts in the early years of an asset's use. This reduces the company's taxable income in these early years, which in turn decreases the amount of income tax the company has to pay in those years. Improve cash flow, reducing tax payments in the early years by taking larger depreciation deductions frees up cash for the company's immediate use. This cash can then be used for other beneficial purposes, such as making additional investments, repaying debt, or funding other operational needs. Improved cash flow in the early stages is particularly important for young companies, companies undergoing expansion, or those requiring large initial capital investments. Better alignment with actual asset value. In certain situations, some assets, especially technological assets or those in rapidly evolving industries, do genuinely lose a larger portion of their economic value or utility much faster in their early years of use. Accelerated depreciation methods can reflect this rapid decline in actual value more accurately on the books than the straight line method. Let's briefly look at examples of the two methods mentioned. Accelerated depreciation, sum of the year's digits method. The calculation is based on the sum of the digits representing the useful life of the asset. In the first year, the highest depreciation amount is recorded, and the amount decreases over time. For example, if the useful life is 5 years, the sum of the digits is 1 plus 2 plus 3 plus 4 plus 5 equals 15. So for a 5-year asset, the fraction in year 1 is 5/15. In year 2, it's 4/15, and so on. The annual depreciation is calculated as remaining useful life at start of year divided by sum of the year's digits, multiplied by depreciation base. Example, a company acquired a commercial building for $1 million. Estimated useful life is 5 years, and residual salvage value is $100,000. Sum of the year's digits, SYD, 1 plus 2 plus 3 plus 4 plus 5 equals 15. Depreciation base, cost minus salvage value. $1 million minus $100,000 equals $900,000. Annual depreciation calculation. Year 1, 5/15 multiplied by $900,000 equals $300,000. Year 2, 4/15 multiplied by $900,000 equals $240,000. Year 3, 3/15 multiplied by $900,000 equals $180,000. Year 4, 2/15 multiplied by $900,000 equals $120,000. Year 5, 1/15 multiplied by $900,000 equals $60,000. Total depreciation equals 300 plus 240 plus 180 plus 120 plus 60 equals $900,000, which is the depreciable base. Accelerated depreciation, double declining balance DDB method. The depreciation rate is typically calculated as double the straight line depreciation rate. For example, if an asset has a useful life of 10 years, the straight line rate is 10% per year, 1/10. The DDB rate would be 20% per year. Each year, this DDB rate is applied to the asset's book value at the beginning of that year, which is cost minus accumulated depreciation from previous years. An important rule. Depreciation stops when the book value reaches the asset's salvage value. The asset is not depreciated below its salvage value. Example, same data as before. Cost equals $1 million. Useful life equals 5 years. Salvage value equals $100,000. Straight line rate. 1/5 years equals 20% per year. Double declining balance rate. 20% multiplied by 2 equals 40% per year. Annual depreciation calculation. Year 1, $1 million initial book value multiplied by 40% equals $400,000. Book value at end of year 1 equals $1 million minus $400,000 equals $600,000. Year 2, $600,000. Book value from end of year 1 multiplied by 40% equals $240,000. Book value at end of year 2 equals $600,000 minus $240,000 equals $360,000. Year 3, $360,000 multiplied by 40% equals $144,000. Book value at end of year 3 equals $360,000 minus $140,000 equals $216,000. Year 4, $216,000 multiplied by 40% equals $86,400. Book value at end of year 4 equals $216,000 minus $86,400 equals $129,600. Year 5, now we need to be careful. If we took $129,600 multiplied by 40%, we'd get $51,840. The book value would then be $129,600 minus $51,840 equals $77,760. This is below the salvage value of $100,000, which is not allowed. So, in the final year, or when the normal calculation would take the book value below salvage value, the depreciation expense is limited. The depreciation in year 5 should only be enough to bring the book value down to the salvage value, but not below it. Book value at start of year 5, end of year 4 equals $129,600. Salvage value equals $100,000. So depreciation in year 5 equals $129,600 minus $100,000 equals $29,600. The total depreciation over 5 years would be $400,000 plus $240,000 plus $140,000 plus $86,400 plus $29,600 equals $900,000, which is the depreciable base period. These accelerated methods provide larger tax shields earlier in an asset's life, which can be beneficial for cash flow. This covers a good portion of depreciation. Are you ready to move on to days inventory outstanding? Days inventory outstanding, DIO. When a real estate developer builds new apartments or a company has properties available for sale or rent, how long does it take for those properties to actually be sold or rented out? This is what Days Inventory Outstanding, or DIO, helps to measure. DIO metric tracks the average duration in days from when an asset, like a newly built apartment or a commercial space, becomes available for sale or rent until it is successfully sold or rented. Think of it as how long your inventory sits on the shelf. Why is DIO important? DIO is an important metric for evaluating a company's operational efficiency, specifically its ability to convert its real estate assets, its inventory, into cash. A low DIO generally indicates that the company is able to sell or rent its assets quickly. This is usually a good sign, as it increases cash flow and reduces holding costs. A high DIO might indicate problems. These could include issues with marketing, incorrect pricing, too high for the market, low demand for the specific type of asset or in that location, or perhaps broader economic headwinds. Relevance to real estate. In the real estate world, inventory can refer to various types of assets such as new apartments or homes built by a developer, land held for development or sale, commercial properties available for lease or sale. Real estate companies, especially developers who want to maintain positive cash flow and profitability, must be able to sell or rent these assets in a timely manner. A high DIO can tie up a lot of capital and increase risks. How do we calculate DIO? The formula for days inventory outstanding is DIO equals average inventory value divided by cost of goods sold for the period multiplied by 365 days. Let's break down those components. Average inventory value. This is often calculated as opening inventory value at the start of the period plus closing inventory value at the end of the period divided by 2. Inventory value here would be the book value or cost of the properties held for sale or rent. Cost of goods sold In the context of a real estate developer selling units, this would be the total cost associated with constructing and preparing those units that were sold during the period. Example of DIO calculation for a developer. Let's consider a real estate company specializing in selling new apartments in a luxury project. Project details. During the year, the company sold all 100 apartments in the project. The annual cost of goods sold for these 100 apartments was $200 million. The average cost, value of each apartment in their inventory system was $2 million. Calculation steps. First step, calculate average inventory value. Opening inventory 100 units. Closing inventory. They sold all the apartments, so closing inventory equals 0 units. Average inventory in units equals 100 plus 0 divided by 2 equals 50 units. Average inventory value equals average inventory units multiplied by average cost per unit equals 50 units multiplied by $2 million per unit equals $100 million. Second step, calculate DIO. DIO equals average inventory value divided by cost of goods sold multiplied by 365 days. DIO equals $100 million divided by $200 million multiplied by 365 days. DIO equals 182.5 days. A DIO of 182.5 days, or about half a year, indicates that, on average, it took the company about 6 months to sell an apartment from the time it was considered available in inventory. In this scenario, this relatively low DIO suggests that the company was able to sell the apartments in this project quite quickly. This could imply high demand for these apartments, a successful marketing strategy, appropriate pricing, or a combination of these positive factors. However, it's crucial to compare this DIO figure with that of similar companies in the same industry and geographic area to get a more accurate picture and proper context. The importance of comparing multiple metrics. The DIO metric is directly affected by the cost of goods sold. This means it can sometimes be misleading if looked at in isolation. If cost of goods sold is high due to inefficiency in production or high material costs, the DIO might look good, be lower, simply because the denominator is inflated, but this actually hides an underlying problem with profitability. If COGS is high due to a high volume of sales, meaning many units were sold, this generally indicates strong business activity and demand. We're going to look at a table that compares two different scenarios for a company. Both scenarios will end up with the same DIO, but as we'll see, their actual operational efficiency and profitability are quite different. Okay, let's break down this table, which compares scenario A, representing efficient operations, and scenario B, representing wasteful operations. Regarding sales, in scenario A, the sales are $300 million, and in scenario B, the sales are also $300 million. So both scenarios start with the same level of sales revenue. Now, let's look at the cost of goods sold. In scenario A, the cost of goods sold is $150 million. However, in scenario B, the cost of goods sold is significantly higher at $225 million. This is a key difference. Next, let's see how this impacts gross profit. For scenario A, with sales of $300 million and COGS of $150 million, the gross profit is $150 million. For scenario B, with the same sales of $300 million but a higher COGS of $225 million, the gross profit is much lower at $75 million. So, scenario A is clearly more profitable at the gross profit level. Let's consider average inventory. In scenario A, the average inventory value is $75 million. In scenario B, the average inventory value is higher at $112.5 million. Now, for the DIO calculation, for scenario A, when you calculate DIO using its average inventory and COGS, you get 182.5 days. For scenario B, using its different average inventory and COGS figures, the days inventory also comes out to be 182.5 days. This is the interesting part. Both scenarios show identical inventory days of 182.5. If we only looked at the DIO, we might think both companies are equally efficient at managing their inventory. However, when we look at the conclusion drawn from these figures for each scenario, for scenario A, the conclusion is that the company has realistic production costs and is under efficient management. This is supported by its lower COGS and higher gross profit. For scenario B, the conclusion is that the company is dealing with expensive inventory and its operations are non economical. This is evident from its very high COGS and consequently lower gross profit, despite achieving the same DIO figure as scenario A. So, as this comparison clearly shows, identical inventory days don't always mean similar operational performance or efficiency. To really understand the true picture of a company's performance, it's crucial to look at DIO in conjunction with other important metrics, such as gross profit, operating margins, and other efficiency ratios. This helps us avoid drawing incorrect conclusions based on a single metric. Next, let's look at how efficiently a company uses all its assets to generate sales. Asset turnover. How good is a company at using everything it owns, its total assets, to generate sales revenue? This is what the asset turnover ratio helps us understand. Asset turnover is a financial metric that measures a company's efficiency in using its assets to generate sales. In other words, it shows how much sales revenue a company generates for every dollar of assets it has. How do we calculate asset turnover? The formula is asset turnover equals net sales divided by average total assets. Let's define those terms. Net sales, this is the total sales revenue generated by the company after deducting any sales returns and allowances or discounts given to customers. Average total assets. Since asset levels can change throughout a period, we usually use an average. This is calculated as total assets at the beginning of the period plus total assets at the end of the period divided by 2. What does the metric mean? A higher asset turnover ratio generally indicates more efficient use of assets. The company is generating more sales for each dollar of assets it holds. A lower asset turnover ratio suggests less efficient use of assets. The company might be holding on to too many unproductive assets or not generating enough sales from the assets it has. As with many ratios, it's important to compare a company's asset turnover ratio with that of similar companies in the same industry, as typical ratios can vary widely between industries. Why is asset turnover important for investors? It's an important metric for both investors and lenders. A company with a high asset turnover may be more profitable because it's making its assets work harder. It's also used to identify trends in how efficiently a company is utilizing its assets over time. A declining trend could be a warning sign. Asset turnover metric is particularly relevant for real estate companies for several reasons. Efficient asset management. Real estate companies typically hold a large volume of assets, such as land, buildings under development, completed buildings for sale, and income generating properties. The asset turnover ratio shows how many dollars in sales the company generates from every dollar invested in these various assets. Performance evaluation. In the real estate industry, where investments in assets are very significant and often long term, this metric helps evaluate a company's performance compared to its peers. It allows investors and lenders to understand whether the company is optimizing the use of its large asset base. Impact on profitability. Efficient asset management, as indicated by a good asset turnover ratio, can lead to higher overall profitability. A company that succeeds in generating high sales from its existing assets can increase its profits and returns. Identifying trends. Tracking the asset turnover ratio over several periods can help identify important trends in asset utilization. For example, a decline in the ratio might indicate problems in asset management, a slowdown in sales, or a decrease in market demand for the company's types of assets. Risk assessment. The real estate industry is often characterized by long project development and cash flow cycles. Therefore, a company that can demonstrate high asset utilization, meaning it can develop and sell or lease its properties efficiently, will generally be perceived as being at lower risk than a company whose assets are sitting idle or taking a very long time to convert into sales. Example of asset turnover calculation. Let's say a real estate company is engaged in the sale of small apartments. Here's their data for the last year. The company sold apartments with a total gross sales value of $5 million. During the year, customers returned apartments, perhaps due to defects or contract cancellations, worth $200,000. The company gave discounts to some customers totaling $100,000. The company's total assets at the beginning of the year were $10 million. The company's total assets at the end of the year were $12 million. Calculation steps: calculate net sales. Net sales equals gross sales minus customer returns minus discounts. Net sales equals $5 million minus $200,000 minus $100,000 equals $4,700,000. Calculate average total assets. $10 million plus $12 million divided by 2 equals $11 million. Calculate asset turnover. Asset turnover equals net sales divided by average total assets equals $4,700,000 divided by $11 million equals 0.427. Interpretation. The company's asset turnover ratio is 0.427. This means that for every dollar the company has invested in assets, it generated approximately 42.7 cents in net sales during the year. This ratio suggests that the company has a relatively large investment in assets compared to the net sales it generates. Whether 0.427 is good or bad depends heavily on the specific segment of the real estate industry and requires comparison to other similar companies. E.g., developers of luxury high-rises might have different turnover rates than quick turnaround home flippers. Finally, let's look at a very direct measure of how well a rental property is doing: the occupancy rate. Occupancy rate. For any property that's meant to be rented out, like an apartment building, an office tower, or a shopping center, one of the most fundamental questions is how much of it is actually occupied by paying tenants. This is measured by the occupancy rate. The occupancy rate is a metric that expresses the percentage of occupied units out of the total available units in a property at a specific point in time or over a period. It's a critical indicator that reflects the demand for a property and is a key factor in its potential profitability. It's a cornerstone tool in real estate decision making. How do we calculate occupancy rate? The formula is simple. Occupancy rate equals number of occupied units divided by total number of available units multiplied by 100. Example: an office building has 100 office units in total. If 80 of these units are currently occupied by tenants, the occupancy rate is 80 occupied units divided by 100 total units times 100 equals 80%. The complementary metric to the occupancy rate is the vacancy rate. This is simply the percentage of units or space that is vacant or available for rent. Vacancy rate equals 100% minus occupancy rate. So in our example, if the occupancy rate is 80%, then the vacancy rate is 20%. Why is occupancy rate important in real estate? Profitability assessment. A high occupancy rate generally indicates strong demand for the property, which usually translates to higher rental income and therefore higher profit potential. Conversely, low occupancy means less income. Risk assessment. A low occupancy rate can indicate difficulty in attracting or retaining tenants for the property. This signals higher risk for the investor as it means lower and less stable income. Decision making. The occupancy rate helps investors and property managers make crucial decisions regarding future investments. Is it a good time to buy more properties in this market if occupancy is high? Property improvements, if occupancy is low, maybe renovations are needed to attract tenants. Changes in rental prices, if occupancy is very high, maybe rents can be increased. If low, rents might need to be adjusted or incentives offered. Property valuation. The occupancy rate directly impacts a property's income stream, EGI and NOI, and therefore significantly affects its market value. A property with a consistently high occupancy rate is generally considered more attractive and valuable to potential investors. Performance evaluation. The occupancy rate allows for the comparison of performance between different properties or for tracking the performance of the same property over time. Is occupancy trending up or down? What influences whether a property is full or has vacancies? Property location. As always in real estate, location is key. Properties in attractive, convenient, and safe locations with good amenities tend to have higher occupancy rates. Market conditions. The overall health of the local economy plays a big role. During periods of economic growth when jobs are plentiful, demand for housing and commercial space tends to be higher, leading to higher occupancy rates. Recessions can have the opposite effect. Property condition, well maintained, modern, and clean properties are much more attractive to potential tenants and tend to have higher occupancy rates than rundown or outdated properties. Rental prices. The rental rates being charged must be competitive for the specific market and property type. If rents are too high, occupancy may suffer. If they are too low, you might have high occupancy but be leaving money on the table. Property management. Efficient and responsive property management can significantly affect occupancy rates. Good managers keep tenants happy, leading to higher retention, market vacant units effectively, and maintain the property well. Poor management can drive tenants away. Understanding and actively managing these factors is key to maximizing a property's occupancy rate and therefore its operational performance. And that brings us to the end of our course on these specific operational performance metrics.